In this week's update, US earnings are great, but seasonal weakness comes to the fore. Time for short-term caution and some profit taking. Gold stocks run into another roadblock, and Bitcoin breakdown looking more and more likely. My name is Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. Well, we're entering into a pretty tricky time of year traditionally, and I suspect a little more so this year because of some of the events that are going on. So, quick market perspective. If you look hard enough, there are just mixed messages absolutely everywhere. And it's not just the media getting it messed up. It's some very, very confusing messages that don't tend to make a lot of sense. So it's not easy at the moment, and I think the thing that investors and traders need to do is to just simply stay quite narrowly focused on your game plan if you've got one. If you haven't got one, you should get out of the market because this is the type of market where you could do a considerable amount of damage. So be very clear about what you're doing, stay focused on that, and just try and shut everything else out is the only way to go, I believe, for the next couple of months, which are the last half of July, August and into September is traditionally a bit weaker. And I think more than ever, just respect the charts and ignore the logic and the media. Really, really important at the moment. So the current realities are these, and there's many of them, but here's some of the key ones from my perspective. Earnings season in the US has been an absolute blowout. There's been tremendous beats. Almost every company reporting is beating expectations. So it's certainly living up to where people might thought it may have got to. So a tremendous earnings season in the US, and it's not just growth year on year compared to a low base in 2020. It's growth in numbers in an absolute sense that are so impressive. Now, retail spending is also very strong, and this is one of the areas of certainly mixed messages. The S&P 500 and the Nasdaq, as we'll see, remain above their 20-day moving averages. Now, they turned down on Friday night, and small caps were quite weak on Friday night. Now, that was options expiry, so that can always sort of cloud the picture quite considerably. But when you step back and have a look, they're above their 20-day moving averages, and that's the definition of a strong uptrend. So, we're still in a strong uptrend, but certainly that could deteriorate over the next few weeks. And there is a lot of the buy the rumour, sell the fact type of dynamics in the market that I've been speaking about now for the last few weeks, where Wall Street has bought up stocks leading into their earnings announcement because they had a pretty good idea what that announcement was going to be. And then, once the announcement's out, there's nothing left to drive the price, and so the profit taking sets in. So we're seeing plenty of that sort of activity at the moment. So if we turn to American stocks, the S&P was weaker by 1% for the week, and most of that decline happened on Friday night. So it's, we've got to give it a little bit of latitude, but most stocks and most sectors declined on Friday night, so it wasn't a great session to finish the week. As I said, the early earnings results, it is only early days, but they're very strong, stronger than I can recall in terms of the numbers of, or the percentage of stocks that are beating expectations. It's close to 100%. So the seasonal weakness is playing out as normal, so I think it's going to be tricky until we get well into September, and then of course we can probably look forward to perhaps some better trading conditions into the end of the year. But look, this is normal. It's partially because of current events, but it's also because of the post-earnings season. When you've had a very strong earnings season, prices run up into it, and then they tend to settle back down a little bit. But look, that's at a general index level, at a general sector level. There are always individual stocks that are doing brilliantly well, and there was a couple of those on Friday night that I own and members own, but the vast majority of stocks did go down. The US dollar was mildly higher, so we're seeing some strength return to the US dollar back to 92.7. The 10-year yield continues to decline, so the market is not at all concerned about inflation. They've absolutely embraced the Fed stance that inflation is merely transitory, and we may get a spike over the next year, 18 months, but it'll settle back down again, because otherwise it makes no sense for the yield is falling because people are buying bonds, and if people are buying bonds, then they're not too worried about inflation. So that certainly has helped the growth stock part of the market with yields falling. Now, the VIX did kick up a bit on Friday night, a bit of a roller coaster during the week, and we've been fluctuating between 16 and 18.5, 19, and the VIX did end on a high on Friday night. So let's jump in and look at some charts. Just a quick reference to Bitcoin. It's looking increasingly likely that this will break support. That's not a prediction, it's just an observation on what the chart looks like. We've had a period of stabilisation. There's no real strength coming through here, and it's starting to roll over, and that sort of rounded top will often lead to a break of key support. And certainly if this level, and I'm sure you've read this in many places, if this 30,000 level breaks, then we're looking at 20,000. There's not a lot in between. So Bitcoin looking pretty precarious, I would have thought. Now, turning to some of the key, we'll look at the S&P first of all, and the Nasdaq. So you can see quite a sharp sell down on Friday night. Pardon me, but still tracking above the green 20-day moving average, and all the moving averages are still aligned in a very positive direction. So yeah, it's just it's an area to keep an eye on. If we look at the Nasdaq quite similar. So it's shown really good strength up until till Friday. But look, that's only one day, and it is a day when we can see some confusing signals, when the market is, let's face it, it's being manipulated quite overtly for the benefit of market makers. And if we look at IWM, this is the Russell 2000 for small caps. It's looking weak. So this market is starting to look a little narrow in terms of its advance to me, and I don't particularly like to see this. So we're now down into a band of support that I've shown here, just entering the top of that band of support, and if that breaks, so that's around 207, and that's only about $8 down on the Russell 2000, so it's not too far. So if that breaks, then we're going to see, I think, some additional weakness in the market, and that having a very narrow market is not a particularly good thing. So that's a key area to keep an eye on. Turning to some of the important spreads, this is the Russell 1000 growth versus value. You can see no real dent there yet, and that's obviously being helped by the falling 10-year Treasury yield. So we've certainly seen a big rebound in the growth sector of the market. But this is one that I watch very closely, and everyone should. This is the ratio between consumer discretionary and consumer staples, and it often gives us very early clues, as I think I covered last week or the week before. There was very early clues back nearly a year before the crash in 2008 that we were seeing a move to go more defensive started in 2007. Now, we're not even close to that sort of signal, but we're in a band in this ratio between 2.4 and 2.6. We were recently trading at the high of that band, and now we're coming off it. So definitely last week there was a shift back towards a more defensive stance, and when you couple that with the relative weakness in the Russell 2000, it just all adds up to a market that that may be going into a period of weakness. and it certainly fits with the seasonality. If we look at the US dollar, you can see it's starting to trend up now. We had a strong breakout. We had a retest of the breakout, so that was pretty perfect in terms of chart pattern, and now we're moving away again. We've got some resistance to get through up here around 93.4. But if that move through there happens, then we've definitely got a more serious trend in the US dollar. Now the Australian dollar, by comparison, is actually falling faster than the US dollar is going up, and you can see now I've been referring to this breakdown now for quite a few weeks. So we had a breakdown quite sharp with several gaps. We rebounded back to test that breakdown, and now we're falling away quite quickly, and there's been no real bounce in the Australian dollar at all. So we finished at 73.5, so quite weak there on the Australian dollar. If we look at the Australian indices now, so overall the Australian market actually went up around 1% for the week because we had a week close the prior Friday, but that's really just a timing issue. I would suggest that it's highly likely the Australian index will be down on Monday. But let's look under the hood a little bit. So our index was really only saved by strength in the major miners, and you can see it had a very good week. In fact, it's had a very good month for the major mining stocks. If we look at energy, I suspect with crude oil falling further on Friday, I think we'll see energy in Australia quite weak, and I would expect we're probably going to head down towards the bottom of this band in the energy index. Financials just dribbling down a little bit, so they didn't change a lot last week. There's been plenty of volatility in healthcare. Healthcare, probably really got ahead of itself, and now we're just getting a pullback to the breakout. So we had a breakout here, and now we're coming back to retest it. So that's how the Australian market looks at the moment. So just to quickly recap, 73.5 on the Australian dollar, which is good for US. If you've got activity in the States, then it's improving the value of your US holdings. So that can't be a bad thing. The US, the ASX 200 up by 1%, as I said. Precious metals, gold was up $3 to $18.12, and as I mentioned last week, the positioning in the futures market is very negative, and that is generally precedes a pretty positive move. So the positioning is really positive for gold and silver at the moment, but it hasn't really moved. There's been no follow through, and I noticed that the GDX was quite weak on Friday night, surprisingly weak, and stocks do tend to lead the metal by a few days to a few weeks. So I wouldn't be surprised to see gold head back down again in the short term. Now GDX is currently oversold. The weakness we saw on Friday night could have just been options expiry, confusing the picture. So I probably want to see how it performs next week. Let's just take a quick look at those charts. So there's the US dollar, the gold price in US dollars on a weekly basis. So not a lot of change, but certainly a bit of selling on Friday night as the US dollar went up. And silver is starting to, which was leading gold for quite some time, has started to look a little bit weaker than gold of late. Oh, sorry, the other chart I need to just take a quick look at is GDX. So GDX, you can see, quite a sharp move on Friday night. Volume was up, but look, I'm prepared to give it a few days into next week just to make sure that this is not just an options expiry phenomenon, which may pass in a couple of days. Turning to other commodities, copper. was pretty much steady around 427, but nickel continues to move higher, and 858 is where it finished. And the dynamics around the nickel market really have it set for sustained rising prices for a long time to come. And some of the very detailed analysis that I've seen suggests that, the period from 2023 onwards, perhaps for at least another 5 years after that, is going to be extremely positive due to just this imbalance in supply and demand. The demand is going up very, very quickly, and supply just cannot be switched on quick enough. It's not a matter of people deciding to develop new mines or not. It just takes time to go through that whole process. So it's likely that we're in for a very strong period for years to come for the nickel price and also for the copper price. Now, crude oil, which got almost up to 78, is now back down to 71.5. And there's a lot of toing and froing going on with OPEC, which is causing a lot of volatility in the price and certainly some negativity. So crude oil had got ahead of itself. It had got overbought up around 78. It was due for a correction, and the OPEC politics is just making that worse. There's the spot copper chart, so not much change last week, but nickel certainly has continued quite a good rebound. Wrapping it up, message is pretty simple this week. This volatility, whilst it's uncomfortable while it's happening, really should be embraced because it provides the opportunity to get into stocks at prices that we haven't had access to for a little while. So take some cash off the table, take some profit where it's appropriate, because there will be bargains presented in this period that you can do very well out of. Decide in advance what you want to buy. Have a decent list. Don't just have a small list. Have a big list so that you don't have to chase prices. You can just wait and pick off whatever comes to you on your terms, and just let the price patterns play out and take advantage of it. So don't be put off by the volatility. Get ready for it, and you should see some good opportunities. Portfolio analyst last week was a lot about understanding the market dynamics, the reality of what goes on in the background that causes prices to do things that sometimes just don't make a lot of sense. So I think members found that very insightful. Managing the changing conditions in the market, this is getting quite tricky, the way that we're getting rotations backwards and forwards, and the period of rotations seem to be getting shorter and shorter. At the start of the year, we had rotations from growth back into value that lasted for months. Now we're getting rotations that are only lasting a few weeks, and then they're flicking back the other way. So it's certainly challenging conditions in the market at the moment. We also talked a fair bit about lithium stocks, and also just the temptation that a lot of investors and traders have to go searching for tips, thinking that if some professional provides a tip that it's a good thing. And my argument was tips are almost useless. It's very much about developing your own process. That's where the real value exists. So it was a good session in Portfolio Analyst last week. If you haven't taken the $1 trial for 2 weeks, I think you'll find a lot of very valuable educational material. That's it for this week. There's my email address and website for more information, and I'll be back with you next Sunday. Cheers.